Hey, everybody. Before we jump into today's episode, I just want to point out a few ways in which you can work with us here at How to SaaS. Number one, if you're an investor and you're in the middle of a transaction and you want to figure out what is the marketing potential of the target investment that I'm looking at, you can engage with us in a due diligence engagement where within 2 weeks, we can give you a very clear picture of all the levers within the marketing function of that organization for them to drive more revenue and pipeline for the business while being incredibly efficient. Number two, if you're the founder, CEO, operator, or investor of a company where marketing is just under leveraged and it's seen as a growth lever that requires more investment, we can come in and do a deep dive across 3 to 4 months and analyze all the opportunities within that business on the marketing side by looking at demand gen, paid media, account-based marketing, content marketing, product marketing, SEO, website, and much more, and come back with a set of recommendations and a roadmap for what marketing needs to execute against to drive more enterprise value for that business. And number three, if you're the CEO of a company that doesn't have a CMO right now, or there's a gap in the organization because the VP of marketing or CMO was recently transitioned out, we can come in a fractional CMO capacity and partner with you on that business and lead the internal team and the operational plan so that the marketing function continues to make progress and drive more pipeline and revenue. And we'll also help you hire your next CMO by being part of that hiring process and onboard that new person once they're ready to join the organization so that they get a running start. These three types of engagements are some of the most common ways in which investors, CEOs, and companies work with us. And we have a proven track record of driving a ton of enterprise value and revenue growth across those companies. To learn more, go to www.howtosas.com, where you'll get a lot more information in terms of the types of engagements I've described. And you can see case studies and other examples of the work that we've done, so you have a lot more confidence in partnering with us. And with that said, let's get to the episode. Enjoy the show. Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv Narayanan, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Vik Thapar, and he is the managing director at Cypress Growth Capital. And what's different and distinctive about Cypress is that they provide entrepreneurs with non-dilutive financing. And this is a topic that's close to my heart in particular, because there's a lot of entrepreneurs that often don't feel like they have many options. It's either bootstrap their business through customer cash flows and be super careful in terms of how you allocate every dollar, or go the route of VCs and raise a bunch of capital, and now you're on the VC treadmill and you're on the hook to grow the business much faster. And I think what Cypress provides is this alternative to either of those avenues, where you can invest in your growth and you can pay back the capital that you've raised from future cash flows. And it allows you to invest in all the areas because you believe in the business, especially if you've identified or figured out product market fit and you have strong growth avenues. So I really liked Vic's perspective in terms of how they approach this. And I think a lot of entrepreneurs, as you're trying to figure out what's the best funding avenue for you, this can be a valid alternative depending on your situation. So with that said, I'll leave you to it. Enjoy the episode. All right, Vic, welcome to the show. How's it going?
Doing great. Thank you for having me, Shiv.
Yeah, excited to have you on. So why don't we start with your background in Cypress and let's go from there.
Yeah, my name is Vic Thapar. I'm a managing director here at Cypress Growth Capital, which is headquartered in Dallas, Texas. We're a team of 8 growing to 11 in the near future. We have a unique way of investing, which is called royalty-based growth capital. What we do is we invest $1 to $5 million into B2B SaaS companies. These are typically bootstrap, growing nicely, founder-owned, founder-led businesses. And they've sort of hit this inflection point where things are going really well. And now they want 2 things. They want capital and help. But at the same token, they're very dilution sensitive and control sensitive. So that is what we solve for at the end of the day.
Walk through that a little bit more, because non-dilutive financing is obviously an option available to founders. Like, when should an entrepreneur consider that, and when should they not? Because in some cases, I can totally see the use case for it, but in other cases, it wouldn't be as beneficial. So just help the audience understand that a little bit more.
Yeah, I would say, if you're a startup where you have little to no revenue, it's really hard for this to be a fit. So I think you do need startup capital to get off the ground, get some, get product market fit to a certain degree. And then once you've hit that inflection point, that's where we're a good fit. If it is a land grab situation where there's a lot of burn expected for the foreseeable future, that's probably a better fit for equity. But what our entrepreneurs see, and we've raised 5 funds and invested in over 60 companies, what they've seen is, they've hit this point where they're 3, 4, 5, 6 million in revenue. And now they have a high degree of confidence where if they just got a couple of million of capital along with some help and guidance, they can easily see themselves crossing that $10 million threshold. And then at that time, then decide, do I raise equity? Do I do nothing? Do I sell the business? They sort of use us as that bridge to get from point A to point B. And then, why would you dilute yourself when you're 4 or 5 million in revenue and you have, all these metrics pointing in the right direction? It seems like it's the least opportune time to actually dilute yourself. You should try to kick that can down the road.
Right. Yeah, I think I definitely see the use case there, because in some cases, like you hear these stories where founders have maybe raised too much money too early, and now they are kind of hamstrung because they're tied to targets from their VC, when maybe just a non-dilutive round would have helped them a lot more.
Yeah, and the most expensive round of capital is the earliest. That's where an entrepreneur faces their most dilution, as well as giving up some level of control. So it's in their best interest to kick the can down the road and own more of the business while the pie is getting bigger.
Yeah, exactly. Are there situations where a structure like this isn't beneficial, because maybe diluting is valuable because you get a VC partner and the dollars associated with that, and you're kind of, there's growth is going a lot faster, and so it makes a lot of sense to bring in capital where instead of paying for it from future revenue or what have you, you're kind of just fueling your growth.
Yeah, I think it sort of depends on the desires of the entrepreneur. So I do think there's nothing wrong with equity. Equity is not bad. There are certain instances where it may make more sense to bring in equity, whether it be something strategic or something like that. But I think at the end of the day, it's sort of it all depends on what the entrepreneur is looking to do. But yeah, I mean, if a strategic can come in, you're comfortable with the dilution because they provide that a huge of a lift. Then I can see a dilutive round being great, or coming alongside us, right? If a strategic is coming in, instead of them putting in 5 million, maybe they put in 2 or 3 and we put in 2 or 3, and together the entrepreneur doesn't really face 5 or 6 million in dilution. They face a couple of million in dilution, and now they get help from a strategic as well as help from us. And one thing I'd like to point out is our entire team of partners and managing directors are all ex-operators and entrepreneurs. And we're full-time. We don't have the operating partner model where folks come and go. So you really get that added value from our team, not just the unique form of investing that we do.
Right. Walk me through the model a little bit more, because, just break down the mechanics a little further. If there's an entrepreneur listening and they're considering their options, right? They can go the VC route, or they can continue bootstrapping, or maybe friends and family kind of rounds. And
yep.
If they are looking at this as one of their options, how does the structure actually work? What are they on the hook for? How are they paying the capital back?
Yeah, so let's say you're a B2B software entrepreneur, started your business, angel funded it, really didn't go down the venture path for whatever reason, and you've hit this 4 million revenue mark, let's just call it. And like I said earlier, the metrics are heading in the right direction. The sales cycle is decreasing. Churn is acceptable. CAC to LTV numbers are really good. And now you're like, wow, I want some capital. And you're not really wanting dilution. And so what we would do is structure an investment. At the end of the day, we invest 1 to 5 million. Oftentimes, because you've taken a bootstrap approach, you really don't need 5, 10, 15 million. So maybe we start with $1 million or 2 million out of the gate, and then built into the term sheet are optional tranches. So it really allows you to have flexibility on how much capital you need day one or in the future, as well as not being forced to take more capital than you need. And so let's say we make an investment. Starting the next month, the entrepreneur will pay a royalty, a fixed percentage of revenue on a monthly basis until a cap is hit. Once that cap is hit, the obligation is over. It's sort of, it's very flexible in that it's very affordable, right? Because these are high margin businesses. The payments flex up and down as the performance of the business flex up and down. And at the end of the day, if you get the lift that you think you're going to get with our capital, with our help and guidance, it's far cheaper than you going down the dilutive path. So it's pretty simple at the end of the day. It's unique and novel. We've been doing it for 15 years, but to this day, we still have people saying, I've never heard of this. I wish I had used this before, but we invest, you pay a percentage of revenue until you hit a cap. Then it's done.
How much is that cap? Help me understand that. Like if let's say you take $1 million, like how much are you paying back? Like 2x, 3x, like what's the percentage on that?
Yeah, the cap is always different, just like valuations are different. Or if you get, financing from a bank, it's different. Typically it ranges somewhere between 1.5 and 2x. And so if you're a 5 million in revenue business, you take $1 million or 2 million from us, you grow to 12 million. Well, maybe at 5 million, you might be worth 30, right? 6 times revenue. Now you graduate to 12 million. Now you might be worth 8x or 10x. Obviously that equity is what the entrepreneur is playing for. That's what the angels are playing for. And we are a much cheaper option than that at the end of the day. So it's really not fair to compare us, for example, to bank debt. Because if you're 5 million bootstrap, not sponsored, you really can't walk into any bank to get bank debt. Maybe a small line of credit, which helps you with working capital. It's either us or dilution, which is equity, that solves their growth capital need.
Right. And so how, like, is the cap amount, like on a journey like that, if we take a percentage of revenue, and I'm putting on my founder or entrepreneur hat right now, and I'm thinking, okay, like if we were to do this for our business, right, like that feels like you could have a lot of cash outflow while growing to 12 million, right? So how do you make sure that the interests are aligned with the entrepreneur, where even though in the short run you're bridging them with the cash that they need, but as they grow, growth also costs money, and you have to invest in cost of acquisition, and you have to hire people, and there's margin erosion that happens over time and stuff like that. Like I'm just thinking about it from a founder's side. So like how much does that end up affecting their cash flow, and what kind of return are you looking for as this type of a bridge financing almost?
Yeah, so we take a really close look at what we call the royalty rate, that percentage. We never want it to be a boat anchor on the business, because it will negatively impact the entrepreneur and their growth, which will at the end of the day have an effect on us. It's not in our best interest for that payment to be too big, because it's going to stifle your growth. So that's why we pay very close attention to their gross margin, their use of funds, their sales and marketing strategy, to sort of get an understanding that we invest $1 million, you're paying us 2% a month, that you have plenty of cash flow to then use to further your growth. And honestly, the capital that they're using from us is predominantly going towards sales and marketing. Yes, they can use it for product development, maybe an acquisition or 2, but it's predominantly going to sales and marketing. And they've gotten a sense of sales and marketing is working. Now I want to put some fuel on that fire. So we have dug in. They have also proven that their sales and marketing strategy is working. And so, yes, we invest $1 million or 2 million. Yes, they are paying us something every month, but it's far better than dilution. And those payments are extremely profitable or affordable. And they're going to reap the benefits relatively quickly, because they have a sales function that is working really well already, and they're looking to double down on it.
Yeah. So is that the qualifier then? Because, if a company is doing 3, 4, I've met 5 companies this week alone that are doing sub 5 million in revenue. And some of them, I like $2-3 million mark. They still haven't sorted out retention or product market fit. And there are core issues that need to be ironed out. And for them to take something like this on, it almost feels like it would add another stressor to the business. So is it safe to say that a company needs to be past that point and need to invest more into growth or have their growth engine figured out? And capital is really the only thing holding them back at that point where it makes sense to leverage a tool like this?
Yeah, I would say they haven't figured everything out, but the signs are all pointing in the right direction, right? Like churn is acceptable, sales cycle isn't too long. A lot of these metrics aren't completely figured out, but a few of them are, and a number of them are heading in the right direction. And so this is definitely not a burden on the business. Cash in the business is never a burden, right? Like you getting millions of dollars, even though like in some form or fashion, you have to pay something, whether it be dilution, a small payment every month, a personal guarantee, or this, that, and the other. We don't ever do personal guarantees, but there is a mechanism to pay the investor back. And in our case, the payment is very affordable, and they have a high degree of confidence that they're going to be able to reap the rewards of our capital relatively quickly and further their growth. So they have a lot of the metrics figured out. They have a lot of the things that, now that they've hit that sort of market product fit, they really, it may not be perfect, but definitely things are heading in the right direction. They have customers, so we can talk to customers during diligence. There's a lot of positive momentum that they want to double down on.
Yeah, totally. And it's funny, what you're saying there resonates a lot with me because companies at this stage have really helped, especially if it's a good business or has good margins, they have good fundamentals, but the thing maybe holding them back is simply access to cash. And so especially when you're bootstrapping and you're building from customer revenue, you having that cash is the difference between growing faster and not. And then if you're left with the only choice if you have is like, I need to give up control or add people to my board and add in that complexity, that feels like a big trade-off. But with a tool like this, you can continue operating your business, control your own destiny, and still fund the growth.
That's right. And I've seen a lot of companies that are venture backed that have raised tens of millions of dollars, and the metrics get confusing, right? You're not profitable. You're adding sales folks. Sales folks are quitting. So you may not have a true sense of all these metrics because the amount of capital you raised can get in the way because you're hiring, quitting. There's so much going on in the business. Our entrepreneurs are scrappy. They've had to do more with less. And so you truly get a sense of the data because, they're hiring people. You see a cohort of logos added in a particular area. You get a good sense of upsell and downsell and churn, et cetera, because it doesn't get convoluted with millions and millions, tens of millions raised, and the metrics just getting a little fuzzy, I would say.
Yeah. Are these companies often using this capital just to put it into programs, or are like when they're coming to you for capital, like are they saying, hey, we need the capital to hire key staff, or what are some areas where the capital, or are they using it to get some liquidity and take some chips off the table?
Yeah, it's really not liquidity because they're not looking for that because they're so bullish on the business. What they're looking for is pretty much 3 use cases. First is putting it towards sales and marketing. The second one is product development, and the third one is potentially a small acquisition. A sales organization, it would be small, right? You're a $5 million business. It's not like it's large, but the signs are pointing in the right direction. And now you added a channel component to it, and it has the early infancy stages of working. And now you want to add folks to double down on that. So it's really not to try something new per se. It's to try something that that is starting to work. And now you want to double down because you have confidence that it's going to pay off.
Yeah. Do you find that are there situations where a founder is bullish on growth? Like, founders often, and myself even, I have ideas that I think are great. And then I want to fund more and more activities. And then sometimes you can kind of get half your own oxygen, right? You think something's great, you want to fund it more. So do you ever run into a problem where a founder is kind of looking for capital to fund some ideas and then it doesn't work out? They don't achieve the growth that they expected, but now they're on the hook to pay back this capital and now it's affecting their margins.
Yeah, I would say, we've had that situation because every deal is not perfect. Entrepreneurs try something out. It doesn't pan off, right? We all want it to pan out. But at the end of the day, because of the type of business it is, given the payment is so small, given there's never a balloon, the company may get its second wind in some form or fashion. The company may continue to grow and sell for a really nice multiple. The beautiful thing is it's not a high burn situation. So they can always live to fight another day. Yes, they might have not reaped the rewards of our capital, but that didn't cause them to lose their company like it would in maybe a venture-backed situation. And so at the end of the day, yeah, they might not have sold for 2, 3, 400 million like they all expected, but they sold for 30 or 40 million. And because they own the vast majority of it, it still was a positive outcome, but maybe not what they were planning to exit for, but still a life-changing number.
Yeah, because I can see that, because you also learn, as if you have more capital, you have time to experiment with some ideas that are just sitting in your backlog as a business, and you kind of are still like, you want to try it, but you don't have the capital to do it. So
yeah, we've invested in a handful of businesses where they didn't come out of the gate growing like a rocket ship with our capital. Like they took our capital, but they didn't, because of the way they've run their business, it may not have grown like we all expected out of the gate, but 18, 24 months, 36 months down the road, something happens. They still obviously can get tranches from us. They seek our help and guidance. And together, they make all the decisions. They do all the work, but they obviously like help, like guidance. And all of a sudden it takes off like a rocket ship and becomes a unicorn. And because, being an entrepreneur, as you know, it's not like this. It goes like this.
Yes.
Even with our capital, it goes like this sometimes. But we're very blessed in that 91% of our entrepreneurs obtain the success they're looking for post our investment. But it's not like this every single time.
Yeah, that's great insight. What about on the operational side? You mentioned that you have a lot of operators on the team, and I'm assuming these founders, especially since they're earlier stage, they could use advice on go-to-market or sales efficiency or marketing. Like, how are you helping them in that area, especially since you kind of have a vested interest, right? Because if they grow faster, I'm assuming you get a significantly higher return on your capital.
Well, the cost of the capital doesn't change, right? Because it's a multiple of the investment. But yeah, the payments would be bigger, but they would be able to afford it because they themselves are growing. But yeah, because of the structure of our team, we provide, one of my colleagues, one of my partners, has exited 2 SaaS companies, both to private equity. One of them we were an investor in, then he did a growth equity round, then they got acquired by LLR partners. One of our other partners bootstrapped his business to 35 million, then exited to a strategic. These are the types of folks you're not going to really find in other firms. Even equity firms, they typically bring in operating partners to sort of solve for that skill set. In our case, we have that skill set in-house, where the first time we talk to an entrepreneur, you're talking to one of us, one of the partners at our firm, versus maybe an analyst and an associate. So the conversation is obviously very different out of the gate. So we definitely help on the sales and marketing front, because that's where they tend to use our capital. But because our companies, we ourselves have exited to private equity, et cetera, our companies have, we bring in that type of advice when they are contemplating a transaction, right? Do I use an investment bank or do I not? Who do I use? What are the typical costs associated? Okay, I have this term sheet. What should I negotiate? They definitely lean on us for all of those things and a bunch of others, right? Along the way.
Yeah. I think all of that makes a ton of sense. How involved are you with the portcos? Because I'm assuming like an entrepreneur that's working with you guys in some ways wants to control their own destiny, right? So if they're taking capital from you, is it almost like, hey, let us take the capital and run with it? Or are they open to actually receiving the feedback and have you guys be more involved with the investment in terms of the value that you bring?
Yeah, so we do not take a board seat. We have no control rights, right? We can't force them to sell or anything like that. So from that perspective, they control their destiny. If they want to sell their company tomorrow, it's entirely their decision. With that being said, they really value our more than capital. They chose Cypress. They chose to partner with Cypress not only because of our unique investment structure, but the fact that they can lean on us for advice. It is very ad hoc. We take the entrepreneur sort of lead on how much or how little of our time they want. But they typically want to take advantage of that, right? Because they want to pick somebody's ear. They want to seek advice and guidance. But at the end of the day, they are the decision maker, but they really value our feedback. And they typically are talking to multiple members of our team, right? We all have different backgrounds. We all have different superpowers, if you want to call it that. We all have different contacts. So they get to know us versus knowing one individual at a firm, which they really appreciate as well.
Yeah, that's great. Yeah, I think a big part of entrepreneurs being open to receiving help in that way, I think goes a long way. How much are you trying to like standardize best practices and things like that across the companies that you're working with? And also, is there like a theme that you're investing around? Or is it just looking at quality businesses with good margins that can actually afford to carry the cost of paying back the capital? Because if you kind of have overlapping themes in those investments, then the amount of operational help that you can provide would be better, no?
Yeah, so we have sort of three areas we invest in. It's 100% B2B. I would say the vast majority of our investments have been in SaaS and tech-enabled service. But we've also invested in managed services like an MSP, which is recurring revenue, but it's a little bit more people-driven and oftentimes tech-enabled these days. And then we also invest in niche consulting. Those are sort of the three areas. I would say they've all become tech-enabled. At least, the managed services and niche consulting are becoming more tech-enabled these days. But I would say those are the three areas. From a vertical standpoint, we're sort of we've invested in a variety of verticals, so we don't really have a particular vertical focus. But on our team, we have experience in IoT, we have experience in oil and gas, we have experience in healthcare. But at the end of the day, the entrepreneurs are all at the same stage, right? So they all have similar problems or issues or sort of things they're thinking about that sort of transcend verticals, right? So, I want to add channel sales to my healthcare SaaS. Well, that might be the same problem or the same initiative of an oil and gas SaaS business, right? So it sort of transcends verticals. So we really don't have, we're never going to know as much as that entrepreneur in that particular vertical, but we're bringing in the expertise of sales and marketing, exit or liquidity discussions, things like that really are, don't really, it doesn't really impact the vertical.
Are you partaking on like the next step that follows all this? Because let's say they've raised capital from you, now they're growing faster, and now they can potentially exit the business, or they want to do some exit planning, or maybe get acquired by a strategic, or raise a different type of round from a minority investor. How involved are you in those stages?
Yeah, about the typical next stop for our entrepreneurs are threefold. The first one is PE recap, strategic exit, or growth equity. About 40% of our companies raise growth equity after us. And we are now raising a growth equity fund to feed those folks that we've known for 12, 18, 24 months. We're looking to lead those rounds. We'll syndicate with our friends because there is benefit to working together on these deals. And from the entrepreneur standpoint, they've sort of dated us for a period of time. And now they've graduated to that point where they're looking for 5, 10, 15 million. There's no better partner than somebody you've been dating. And from our vantage point, it's the same thing. There's no requirement for us to invest or for them to take our capital. But if we've been advising and helping for 12, 18 months, it just seems like a natural fit for both sides.
Yeah. I guess another big benefit that you're bringing is just the network itself, right? Because you're connected to so many private equity folks, because that ends up being deal flow for the PE firms as well. So talk a bit about that. Like, are you doing, beyond the entrepreneurs, are you doing work with the PE firms as well as they're looking at their businesses and portfolio companies?
Yeah, we our team talks to PE growth equity strategics on a weekly basis. We have recurring calls with, all the folks and more, for a variety of reasons, for knowledge sharing, deal flow sharing, just expanding our network, things like that. So that's a big part of our business, is to just continue to network, predominantly for deal flow. What we've seen in the market is folks have moved up market. Our growth equity fund is going to be writing $5 to $15 million checks. And we feel like that's a gap that's somewhat underserved. And then, we would feed into the buyout funds, the much larger growth equity funds, et cetera. And so over the last 15 years, we've just seen people move up market. And this is a place that we've been playing in, and we're going to take, with SPVs, things like that. And now we're going to take a big leap and add this new strategy to our firm that we're really excited about, really bullish on. We're going to be adding 3 folks to the team in Q1. So we're really excited.
Yeah. In terms of the funds themselves, tell me about, we're hearing a lot from PE firms lately that continuation vehicles and other types of fundraising is becoming important for them to return money to LPs. How much of that is playing a role in terms of the work that you're doing with PE firms?
Yeah, I would say it's not really continuation vehicle related. It's more, these PE funds are getting a better understanding of what's going on at an earlier stage, because they want to track them and see the ones that sort of grow into them. So it's sort of deal flow sharing. What are on the minds of entrepreneurs? What are valuations like from their perspective, et cetera? Because we're seeing those companies at an earlier stage and they're bootstrapped, right? Like the companies we're talking to are angel funded, right? So they've done safe notes, convertible notes, things like that. They've not really had a typical formal round, I would say. Maybe in some cases they have, but typically that's not in play. So it's really sharing what we know to these bigger funds about what's going on at an earlier stage. And then they obviously meet entrepreneurs that are at an earlier stage and they're sharing deal flow with us.
Yeah, that's really interesting. What advice would you have for founders that are kind of considering this? Because obviously a lot of founders and entrepreneurs listen to this podcast, and as do investors. Like, as if they're considering their options, like, when should they kind of reach out to someone like yourself and look at this as like the avenue that they should kind of go with?
Yeah, if you're really bullish on your future growth, you really think you have something extremely valuable, why would you want to shed equity early on? And so if you're really bullish on, if I got this dollar, I have a high degree of confidence I'm going to yield this result, that's when we're a great match. If you're venture backed and you continue to raise round after round, you're probably not a fit for us. But at the end of the day, if you're bootstrapped, if you need a couple of $1 million from us, then your next stop is a growth equity round potentially. That's where we could potentially partner in multiple facets. But at the end of the day, if you're looking for capital from us from a royalty perspective, and then your next stop is an exit, that's fine as well. I saw this Jason Lemkin from SaaStr quote where he invested in an early stage business. They got a nice exit offer of, I want to say, $100 million. They didn't take it. They continued to raise round after round after round. They eventually sold for a unicorn level, but the entrepreneurs actually made the same amount of money at the end of the day, or even less. And it was probably a harder journey because of all the rounds of capital and the dilution and the folks on that ended up probably taking more and more control. So in our scenario, you sort of control your destiny. It doesn't limit you from not being a unicorn. Many of our companies have been unicorns, but it just allows you to own a bigger piece of the pie early on, but still obtain that large exit if you want.
Yeah, that's fantastic. last but not least, and we're coming up on time here, what's the best way founders and entrepreneurs can reach out to you if they want to learn more about Cypress and potentially work with you guys?
Yeah, shoot me an email. We're very we like talking to entrepreneurs. Obviously, we respond to all emails. We're not one of those firms that doesn't respond. So shoot me an email. Vik Thapar, VTHAPAR @cypressgrowthcapital.com. I'm also on LinkedIn and check it regularly. So feel free to shoot me a LinkedIn message. And then, our website, cypressgrowthcapital.com, also has an inquiries link. So you can also shoot an email by clicking there, and it goes to my inbox, actually. And we will respond.
Awesome. Yeah, we'll be sure to link all of that in the show notes, Vic. But beyond that, just I want to say thank you for coming on and sharing your wisdom. There are a lot of entrepreneurs like myself who often are considering, like, what's the best way to grow their business forward, and should they raise a lot of capital or take on dilution and all the headaches that come with that. And you presented a really great alternative. So appreciate you coming on and doing this.
No, I appreciate you having me on. If there's any other questions, feel free to reach out. But thank you again, Shiv, for having me on.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosaas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.